Investors, the Federal Reserve is in their blackout period. Tech has been driving the market, and an interest rate hike may very well be on the way. Man, oh man, we have a lot to cover today. But if you're new here, I'm Ari, your go-to dividend investor on YouTube, sharing everything you need to know when it comes to important economic insights and, moreover, ripe dividend stock ideas. As for today, we'll quickly go through our economic backdrop together and then run right through 5 dividend stocks worth your attention right now. With that said, let's get right to it. So just from last Sunday to this Sunday, my account has been on the up and up, currently sitting at $117,608.88. That's up by over $5,000 in just the last handful of days or so. So what's the deal? Well, first and foremost, the Federal Reserve has been in their blackout period, given the next FOMC meeting is on the 13th and 14th, which ultimately means that Jerome Powell and the gang are off the grid, refraining from any and all media attention. Now that means that we then usually see this phenomenon of emotional investing, a term that I did make up, but it couldn't be more suitable. And it's just to say that when the Federal Reserve disappears, there's an absence of negative news or the necessary doses of economic reality. And instead, we see investors rallying over anything. Point in case, this past week, it's been all the AI hype, whereas tech is just booming.
After a really difficult 2022, tech-focused hedge funds came roaring back in May to be the best performing strategy year to date.
Without a doubt, the hottest stock of 2023.
The $1 trillion club getting a new member today. NVIDIA becoming the first ever chip stock to reach that milestone. An astounding run for a stock that has just simply soared.
For the S&P, up more than 7%, but according to SocGen, it's actually due to AI, saying that the index would be down 2% on the year if not for some popular AI names.
That and the fact that the Federal Reserve just may pause on interest rate hikes moving forward following the upcoming meeting. But either way, be aware that this market momentum may be short-lived. Not too long ago, a non-farm payroll came out depicting an acceleration in job growth in May, as we saw an increase of 339,000 jobs added to the economy when we were only expecting 190,000. That means that the labor market remains robust, and while our next CPI report is likely to come in another notch down, the question is whether the Fed will be deterred from increasing interest rates by another 25 basis points. My thoughts? I think not. I think we have a labor market that can handle another interest rate hike. And after all, we are still very far from that 2% inflation goal. But that's just me. If you think otherwise, let me know by commenting down below. Now, either way, the environment that we're talking about here and that we're actually creating for ourselves, regardless of what happens this upcoming week, will be dangerous. So let that be the warning for you. You see, inflation may come down, but anything above that 2% inflation goal is considered high, and interest rates, whether or not they're raised this upcoming week, are still squeezing the life out of businesses and consumers, and it's only a matter of time before more volatile times. But we can and should be using this time to just keep buying more dividend stocks for the long term, which leads me to the very first dividend stock that I want to cover today, which is Cisco, ticker symbol CSCO, which offers a broad range of technologies across networking, security, collaboration, applications, and cloud. Now, most recently, Cisco just got a huge boost from all the AI advancements, given the company just announced the usage of generative AI. So if you're looking for a dividend stock with a hand in AI, Cisco now checks that box. But what we're really here for is a solid dividend company, to which Cisco is such a company. And while it has been in the green lately, trading for $49.68 per share, that's up 5+% on the year, its price to earnings ratio is rather low at 17.9, which ultimately, all told, I think drives smart money, and very optimistically, as we can see plenty of hedge funds loading up on Cisco, with analysts also forecasting a hefty amount of upside, nearly 18% of it, with Cisco rising to $58.30 per share. Now, until then, investors will also enjoy the Cisco dividend, with that yield of theirs coming in at 3.07%. Now, before we get into any more of these dividend stocks, I want to take a moment to ask for your help in helping me. How simple. If you find value in today's video, simply tap on that thumbs up button so I can keep creating content just like this. And of course, subscribe while you're at it to never miss another video. Now with that, let's move into the healthcare sector for the following two dividend stocks, with the first being Bristol Myers, ticker symbol BMY, which is a global pharmaceutical company engaged in the development, licensing, manufacturing, and distribution of pharmaceutical products in multiple therapeutic areas, from cancers to HIV, cardiovascular diseases, diabetes, and more. Now, if you're looking for more of a discount, you're going to get it with Bristol Myers, as it's currently down by almost 9% on the year, trading for just $65.31 per share, with a PE ratio coming in under 20 and 19.2, which I would really like to attribute to the turning of the tides more recently in the market, with more market optimists trying to capitalize on riskier growth investments. But this then leaves Bristol Myers as an investment open to all of us, with hedge funds already beating us to the punch. And once again, we're at least covered by analysts who are also forecasting a rise in the share price to $77 per share, which is just about 18% worth of upside. But shareholders will also be enjoying their dividend in the meantime, with Bristol Myers dividend yield coming in at 3.36%. Next up, our second healthcare investment of the day, Amgen, ticker symbol AMGN, which is going to cost you a pretty penny, but I do believe it's well worth it for its value. Amgen is one of the world's leading biotechs engaged in the discovery, development, and manufacturing of multiple therapeutics that deal with inflammation, oncology, bone health, cardiovascular diseases, and neuroscience. But the good news when it comes to Amgen is that it's down by a little over 14%, currently trading for $220 per share, with a PE ratio coming in at just 15.1. And for likely similar reasons to Bristol Myers' downfall. But now check this out. We also have plenty of smart money moves being made on Amgen, along with analysts who are also forecasting a solid chunk of upside, over 20% worth of it, with Amgen coming up to a share price of $266.25 per share. Now, until we see Amgen back on the up and up, all shareholders will be able to capitalize on Amgen's dividend yield when it's coming in at 3.67%. Now, coming up to dividend stock number 4, it's one that I believe is one of the best home improvement investments for all dividend investors. We have Stanley Black & Decker, ticker symbol SWK. In full disclosure, I am a shareholder of Stanley Black as well and invested during its most recent lows. But nonetheless, why Stanley Black? Easy. It's not only one of the largest hand and power tool manufacturers in the world, but one of the largest suppliers to some of our go-to home improvement retailers like Home Depot and Lowe's. Now that should speak volumes to its sheer reliability. However, there is more to understand here, as our current economic conditions are not so favorable to Stanley Black, given every data set from housing starts to new home sales and just overall a decrease in construction. We can now certainly understand why it's only trading for $86 per share, which is down from its peak this year of $94 per share. But mark my words now, when the market flips, Stanley Black will be back. Therefore, we have analysts already predicting near-term upside coming back up to $91.33 per share. But over the longer term, I foresee much more upside. And of course, at the end of the day, being here for their dividend, here we are with Stanley Black & Decker's dividend yield coming in at 4.02%. And last but not least, Fidelity National Financial, ticker symbol FNF, not to be confused with Fidelity Investments, as Fidelity National is engaged in the provision of title insurance and transaction services related to real estate and the mortgage industry, which again, based on our economic environment, you can already probably guess it's not been performing as well in the year here, whereas it's down by almost 4%, trading for $35.37 per share, with that PE ratio at a low here of just 14.2. And that all presents an opportunity for a buy and hold, at least until an economic recovery, which is why we likely will see plenty of hedge funds pouring millions into this position with Fidelity National. Now, on top of all of that, analysts are also expecting a comeback with a forecasted share price of upwards of $45 per share. That's over 27% worth of upside. And until the market flips, shareholders will reap the benefit of Fidelity National's whopping 5.1% dividend yield. Now, that's a wrap, investors. The 5 dividend stocks to add to your watch list this week. But now I have to know your thoughts here. Simply drop a comment or two down below to let me know. And don't forget to tap on that thumbs up button while also subscribing to never miss another video. Or better yet, just click right here for the next video.